So how can you profit from the S&P 500 without buying any stocks, without buying any indexes or indices? How to take advantage of the movement of the S&P 500. So here's a trade I made 2 days ago on the S&P 500. It's an options trade, so I didn't have to buy any stock, and it's on the SPX index, which represents, of course, the S&P 500. So basically all I said, when the S&P 500 was trading at around 2,900, I placed an iron condor trade expiring June 21st, so about 45 days out. I said to myself that the index will not go below 2760 by June 21st and will not go above 3050 by June 21st. So as long as the index stays within that range, I make my max profit come expiry date. Right now, the S&P 500 is trading at 2870, so it seems almost in the middle. So my max profit on this trade is $125. My risk on this trade is $375. So if the S&P 500 stays between 2760 and 3050 by June 21st, then I'll make my max profit of $125, which represents a return of 33%. I start losing money when the S&P 500 goes outside of that range. So if it drops below 2760 or goes above 3050, then I start losing money. The max that I could lose is $375. My break even is if the S&P 500 closes at 3051.25 or 2758.75 come June 21st. That's my break even. Basically, it's my short strikes minus the credit that I already collected. But at any time between now and June 21st, so let's say 20 days later, let's say 20 days into this trade, if the S&P 500 is still trading far from the borderlines or the limits of 2760 and 3050, I could buy back this option trade lower than what I sold it at. So I sold it for $1.25. Maybe I can buy it back for like $50. So this is one of the safest trades you can make to take advantage of the S&P 500, especially when it drops, because when it drops, implied volatility is higher, so the option premiums are higher. You can collect more. So as long as you give yourself a very wide range by choosing a delta of around 5, the day you place your trade, if you make sure that on both sides, the put side and the call side, you have a delta of 5 on the short strikes, you're giving yourself a 90% chance of success, especially that it's an index, so it doesn't move as hard as one specific stock. I mean, one specific stock can drop hard or go up really fast depending on news or earnings, but an index doesn't move as hard as one stock. So yeah, so this is an option trade called the Iron Condor, and of course, any profits you make is taxable, 100% taxable. It's not considered a capital gain; it's considered income. So when I placed this trade, I had chosen 5 deltas, but now, as you can see, the put side has become a 10 delta because the stock dropped a little bit more. So now my put side is getting tested, but not by much. I mean, when it gets to a 30 delta, then I can start to worry about it. But I mean, at a 10 delta, I guess I'm still fine. I mean, there are ways to manage this. If it gets to a 30 delta, I can probably close the call side of the trade and get closer. So instead of selling a call option at 30.50, I can close it and then sell a call option at 3,000, for example. So I'll collect an extra premium, but obviously reducing my range of profitability. So at first, my range of profitability was 2760 to 3050. If the stock keeps getting closer to my put side of 2760, then I have to start managing this trade. Even though my max loss is 375, but I don't want to lose that. I don't want to make that max loss, so I can try to mitigate it by managing my iron condors early. So if my put side starts getting to a 30 delta, then I can close the call side and get closer, collect an extra premium, keeping the same expiry date, but changing the strikes, of course. And another thing I could do is I could also close the put side and immediately sell another put option, but further out. So let's say the S&P 500 starts getting closer to 2,800. So it's getting closer to 2760. So what I could do is close this trade. I'll pay for it, of course. I won't be paying max loss though, but I'll probably be paying, let's say, $150 or $200. But I can right away sell another put option a little bit lower, let's say at 2,600 or 2,650. Collect the premium there. Plus, by closing the call side and selling another call option a little bit closer, let's say at 3,000 or 2,950, then I collect another premium there. So that would be a way to avoid max loss on this trade, and that's why I consider this one of the safest trades. It's a little bit hard to manage sometimes. It's definitely more time consuming, and it gets very difficult when you trade it on a stock, a particular stock, because stock can move hard in one direction at any point in time. But the max really usually indexes don't move that hard in one day. So just want to share with you this this trade I placed on the SPX index. If you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. And if you want to get trade alerts as soon as I place them, you can join my WhatsApp group for $10 a month. I'll be sending my trades as soon as I place them live. And of course, if you're looking for an accountant to do your taxes, don't hesitate to message me. Link will be provided below. Thanks for watching.